All right, buddy, welcome back to Ox Talks. Appreciate you tuning in and watching the show. Thanks for supporting the channel, hitting the thumbs up button, the like button, sharing the videos with folks, everybody you know and care about. And please also hit that subscribe button for me if you haven't done so. The topic I wanted to cover in this video has to do with the stock market, and it discusses the valuations overall, the levels that these stocks, some of them are trading at. And I saw an article out of Business Insider, which came out yesterday afternoon, that on the heels of a pretty steep sell-off in the markets to close out last Friday, which I covered on Friday's show, the barn burner episode. If you haven't seen it, go check it out, please, from Friday. But I thought this was an interesting article to share with you on the heels of this. Now, look, you've got most people out there, like Greg Marino and others that are market people, and I'm not one of those, but they're saying, get on the gravy train here, because with the new administration coming in and with the promise of lower taxes and lower rates, that the market is going to continue to go up, and that there's a lot of money to be made and don't get left behind type thing. So, that seems to me, when I see what I see across, social media, and even, of course, the mainstream media saying, there's no bad time to buy the market right now because it's going to only go in one direction, and that's positive. You have some contrarian views out there, and I want to bring one. I saw one article today that obviously this guy is a bit of a contrarian, not necessarily in the immediate short term, but certainly in the coming months or maybe year or a couple of years, relative to what could happen to this market. And again, you market people, do you really believe? I mean, it's a rhetorical question, but can you time this market? Or do you get, it's a situation where if you're margined out, if you're taking unnecessary risk, reaching for yield, whatever it is, and the rug gets pulled out, what happens? Again, if your money is tied up in a 401k, you don't have much choice, right? You're just basically, you're investing it to the extent that you can control that. If you're taking risk in your retirement accounts for those purposes, that's obviously going to be on you. I've had friends that in the dot-com bubble, which we'll show the article in a few minutes, the dot-com bubble and the 07, 08, 09 financial crisis, that they got basically wiped out, or pretty darn near close to it. Some did get wiped out. Okay, let me jump into the article. This is from Business Insider. This looks and feels like the year 2000 to me. Investing legend Rob Arnott says the stock market's record rally reminds him of the dot-com bubble peak. Rob Arnott says he's usually early when calling a bull market top. So when he says the current market environment reminds him a lot of the dot-com bubble peak, it doesn't mean he thinks a significant pullback is imminent. It does mean, however, that he sees a big decline somewhere not too far off. This looks and feels like the year 2000 to me, he told Business Insider on November the 11th. Are we likely to see a bear market in the next 2 years for large cap growth? ? And he says yes. Says, but Arnott believes AI optimism, which has driven the lion's share of the rally, is already fully priced in. A robust economy and excitement about artificial intelligence and business-friendly policies from the future Trump administration have propelled the markets to all-time highs. This guy thinks AI optimism is already priced in. Again, if you're market folks, leave your comments below. He says those high expectations are visible in the S&P 500's Shiller cyclically adjusted price to earnings ratio, he says, which sits at levels that rival the dot-com bubble peak at 37 times earnings, just below the late 2021 peak of 38, before the market fell by 25%, and the 2000 peak of 43 right in front of a 50% crash in the market in the year 2000. And I did have a friend of mine, a very close friend of mine, that was heavily invested in, and that was the meme for today, that all the dot-com stocks, And I think he was sitting on, it was multi-million dollar trading account. And I think it was cut probably by 80% because he kept thinking that it's going to come back. And it kept dropping, and a lot of those companies didn't come back. They basically went belly up. He says the problem with high expectations is that the results eventually have to live up to them. But a couple of factors threaten the market's bullish narrative, he says. One is that companies like NVIDIA will be able to keep their 90% market share as competition rises and the cost of chips eventually comes down. I think the point was, will they be able to keep their market share? If you posed the question 5 years ago, the presumption would have been that that Intel would be the predominant player, he says. Well, Intel is teetering perilously close to irrelevance, and NVIDIA wasn't on anyone's radar screen 5 years ago. So disruptors, he says, get disrupted. There's also the possibility that the pace of AI adoption is slower than expected. Arnault said he said internet use in 2005 wasn't all that different from its use in 2000, but that today things have completely changed. A longer timeline may play out for AI as well, he says. Arnault joins a long list of strategists and money managers who have recently expressed lackluster outlooks about forward return prospects given the state of stock valuations. Goldman Sachs chief U.S. equity strategist David Kostin made waves in October when he said the S&P 500 would deliver 3% annualized returns over the next 10 years. In an interview with Business Insider, he also made a similar point to Arnault in that the valuations of some of the market's most loved names are much higher than the rest of the pack. Similar, again, to what happened during the dot-com bubble. Bank of America's global chief equity strategist Michael Hartnett said in a client note on Friday that U.S. stocks have outperformed relative to equities in the rest of the world to the most extreme degree, listen to this, in 75 years. Relative performance levels have reached elevated levels in prior asset bubbles like the so-called Nifty 50 and the dot-com peaks. Like both Arnault and Hartnett say, it's hard to call the top. As short-term interest rates fall and the market-friendly policies of the incoming Trump administration on the way, the rally could continue for months or years. But history shows there will likely eventually be cheaper times to buy into the market, said David Einhorn, founder of hedge fund Greenlight Capital at CNBC's Delivering Alpha conference last Wednesday. This is really pricey environment, a really pricey environment. He says that doesn't necessarily make it bearish. Asset prices can trade at the wrong price, and they can trade at the wrong price for a long period of time, he said. I just observed that it's a really expensive market if you buy and hold for a very long period of time. I doubt this is a great dash. You'll look back and say this was a great entry point of all the entry points that you could have made. I don't understand that quote. The way Arnault sees things, the better entry point could come in the next couple of years. So these guys are obviously, saying that this is going to have to adjust at some point. There'll have to be an adjustment to fair market value. What's going to trigger that? Who knows? Can you time it so that you don't get hurt, so you make money on the way up, but you don't lose money on the way down? I sure hope for most of you that you can have your hedges on and just be prepared for anything. We'll see if the sell-off continues, guys, into tomorrow. Again, I'm not a stock market guy. I don't know what to expect. Lots of stuff going on right now, a lot of uncertainty. The appointments are coming in right now, and we're going to have all these confirmations, and it's going to get extremely tense with regard to what's going to happen economically and what the policies are going to be and how aggressive they're going to be implemented right out of the gates. Looks to me like it's hitting the ground running. Okay, I'll leave it there today. I'll be under 10 minutes. Again, thanks for liking, sharing, and subscribing to the channel. Have a great rest of your day. Talk to you all soon. Bye.